Tesla has earnings this week, and as of right now, we're just sitting here within a symmetrical triangle. Now today, I had a pretty good day, closed out for a good amount of profits, took some wins and some losses on Tesla. And what we're going to go over in this video is the unusual options flow for Tesla, talk about how it's been a little light, talk about what are some levels to watch as we go into earnings, and ultimately what my plans are, because I have 400 shares of Tesla long term. I definitely do not plan to swing that trade through earnings unprotected. So we're going to go over a little bit of that today, and we're going to talk a little bit about Delta and how to Delta hedge out some positions. My name is Peter DiCarlo. I run a trading community with over 12,000 members. Our Discord is completely free. The link is in the description, and you guys can get access to all of our courses, live streams, seminars, webinars, all of it over there for free. And follow me on Twitter because I throw a lot of my trades out there as well if you guys want to follow along. So before we go into how this is setting up this week, I just want to zoom out and take a look at basically past 2 years. We can see in November of 2021, we had this high on Tesla up over 408, and we've been respecting this trend line until finally breaking over it in May of 2023. Since then, it's been very hard for Tesla to push up over this level of $280 to $300. And if we were to actually take our Fibonacci retracement level and draw it from our swing high down to swing low, you'll notice that the main area that we've been having trouble to get through is our golden Fibonacci level. Now, this golden zone is a phenomenal way to tell when a good time to continue with this trend would be, or where the potential reversal would end up happening. And so we can see that as Tesla goes into earnings, we are squeezing, we are sitting here, and we will be looking for either the break up over 275 to move us up to 300, or this bearish move under 240 to move us back down to $200. Now, if we're to go through and actually turn our indicators on, you're going to see that there is a lot of information that we're currently watching. If I were to go through and just remove all of these drawings on the weekly, you can see that we have a bullish order block that is sitting here from about $215 up to $242. This is a bullish institutional level, and usually we will bounce off of these order blocks, especially if we respect them. The way that you can tell that we are respecting them is every single time that we do come down to touch this order block, we are bouncing perfectly. This is definitely a good technical sign as Tesla moves into earnings. Now, the next thing to be cognizant of is going to be this purple line down here. And basically what this is going to show is how much volume is coming into the stock. As the stock is squeezing here, the fact that there's a lot of volume coming into this is a good sign that we will probably see Tesla move its way up to 300 and maybe even up to 370 within the next 3, maybe 4 months. Now, of course, earnings is always going to be the back of what's going to cause this move to the upside or the downside. Technical analysis is great. The fact that buyers are coming in is great. The fact that we're squeezing is great. The fact that the bullish order block is there is great. But at the end of the day, earnings is ultimately going to be, and specifically guidance, is going to be what drives this stock forward. And if we look at the unusual options flow today, pretty light once again, $11.2 million, which sounds like a lot of confirmed flow, but for Tesla, it's really not. We can see that there was some unusual buying, some people selling cash secured puts for this Friday at 247, a lot of people selling covered calls at 260 for this Friday. So this could have been, I don't think that this is a spread because it's too far away, but a lot of people putting this line in the sand of 247 and 260. Now, top bearish flow was SQ with 14.34 million and NVIDIA with 10 million. NVIDIA was down a lot today. Now, what's my actual plan for Tesla as we go into earnings that will be happening? I believe it's tomorrow on Wednesday, the 18th. So yeah, going into tomorrow, what is my plan? What do I plan to do with my position? Well, something that I could do is sell covered calls, which just means that I can take the 400 shares that I own of Tesla and I could say, I don't think Tesla's going to close above $300 by this Friday. And so what I would do is sell a covered call. And as long as Tesla closes below this $300 level, I will make a profit. And so let's say that even if Tesla broke out and moved our way up to 290, but didn't close above $300, that would be very good for me, because not only would I make the money on the shares, which is about 14%, but I would also get to keep the premium for the covered call that I sold. But the more realistic thing that I'm probably going to do is open some sort of put position if I decide not to do covered calls. Now, put positions are very tough, especially when we're going into earnings season. And the reason for this is we have implied volatility, which is going to be raised. Now, for some of you, if you don't know what implied volatility is, essentially as market makers and the overall consensus of the market is evaluating the market structure and evaluating, as market makers are evaluating the market, what they're doing is they're baking into, when you purchase a contract, you are going to have what's called implied volatility. And this basically means how much market makers believe that the stock is going to move. So if you've ever bought in calls or puts on a position going into earnings, and let's say in this instance, Tesla rips 10%, you probably wake up the next morning expecting your contracts to be up double, maybe even triple. And instead, you're only up 40, 50%, which is still phenomenal, but you're wondering, well, how come I see all these other people who have multi-100% returns? And the reason for that is the massive move occurred, but it occurred when implied volatility was low. If the market expects the stock to move drastically, implied volatility will go up. And as implied volatility goes up, so will the price or the premium of the contract that you're trading, which sounds good. But the problem is, once the volatility is removed, i.e. after earnings occurs, then the implied volatility drops and the price of the contract drops. This is called IV crush or implied volatility crush. Now, something that I want to talk about is going to be delta. Delta is very, very important when it comes to potentially hedging out a position. And so if you look here on the left side of your screen at the bottom, we're just going to be using this Friday expiration of 255 calls as a brief example. This is not something that I would ever trade. We're going to actually look at some contracts that I would look at in the future. But this has a delta of 0.5. Tesla went up by $1. We would make $51.35 for every one of these contracts that we held. Now, something that's extremely important to understand is that if you own one share of a stock, your delta is 1. So that means in this instance, I own 400 shares of Tesla, meaning that my delta on my long-term position is 400. So if I wanted to actually cover this position and I wanted to figure out a way that I could be even, what I would do is go to puts. I'm going to look at November 17th. And what we're going to do is look somewhere near the strike. I really like to go with like right below or right at the strike, somewhere around like 255 or 250. And what we're going to do is look, the delta on this contract is negative 40. Now, if I wanted my position to be fully hedged, meaning that no matter what happens, I will not lose money or make money. I will sit sideways. The way to do this is I would have to cover the delta of the current trade that I'm holding right now, which is 400 shares of Tesla. So I have a positive delta of 400, and I would have to take on a negative 4 delta in order to be fully hedged. Meaning if we were to go with these contracts that have a negative 47 delta, I would have to buy 8 of these contracts just to hedge my position. And if you were to look, these contracts would end up having somewhere around 400, negative 400 delta, and these contracts would cost somewhere around about $900 per contract, actually $1,122 to $1,130. So basically an $8,900 position would end up covering an $1,000 position. So overall, very, very solid. However, I do not plan to cover my long position entirely because I do actually believe that Tesla will probably move its way up to $300 within the next couple of weeks. I do think earnings will probably be good, and I don't want to lose out on that upward momentum and that upward movement on my long-term shares. So what I'll probably do is go with something like a November 17th 1 month output, but I'll probably go with 2 or 3 of them, and I will only delta hedge half of my position so that if the market goes against us and Tesla drops down to $200, I won't lose a ton of capital because my puts will be keeping up with the slack. But if Tesla does run, I won't miss out on all of those juicy gains simply because I have so many puts in place. I hope that this video helped, guys. Check out our Discord community, all of our free trading resources, our free community, our free courses. Everything is down below. If you guys want to get access to my trades completely for free your first month, we are ending this as of tomorrow because we do have, unfortunately, a lot of people who just come in and join who are scammers and spammers. But The first month is completely free. If you want access to all of my trades, tomorrow by 2 p.m. the link will be dead and it will no longer be free for your first month. So go take advantage of it now, guys. I'll see you next time. Peace.